Welcome back to our financial accounting and reporting class. For today, I am going to demonstrate to you how to prepare worksheet for a merchandising concern. To help illustrate the process, I will be using the exercise found in your handbook. That's exercise 4.1, worksheet preparation for a merchandising company, periodic inventory system. So the problem focuses on David's Music Store Incorporated, and it requires the preparation of worksheet using adjusting entry method. So as a quick review, we have two ways on how to prepare the adjustments for the inventory end. We have the adjusting entry method and the closing entry method. So as its name suggests, it identifies where you will find or where you will prepare the adjustments for the inventory end or ending inventory. So if we're using the adjusting entry method, you will write or you will prepare the adjustments for your ending inventory in the adjusting entries, or you can find it here under the column of the adjustments. If we're using closing entry method, you will not find the adjustments for the ending inventory under this column, or you will not prepare an adjusting entry for the ending inventory, but rather you will prepare a closing entry. So it will be combined with the other closing entries that are necessary at year end. That's why it's called as a closing entry method. So going back, since this problem requires the preparation of worksheet using adjusting entry method, therefore the inventory end or the ending inventory will be part of the adjusting entries, and so we will find the inventory and here under the adjustments. So let's proceed. So I have already placed here the appropriate amounts and the column headings, and of course our worksheet heading. So it will start with the company name and then the name of the statement, which is worksheet, and the period covered. So for this one, their fiscal year ends in November 30, 20XX. So let's start with the first information. So you have ending merchandise inventory is 99,681 pesos. So our entry would be, we will debit. So we will check what account was being used. So that's inventory. So we will write here inventory, and the amount is 99,681. And then you credit income summary. So the same amount, so we'll just copy. For letter B, we have store supplies inventory. So let's check what is the initial entry made. So we will find it here on the existing account titles. We have here store supplies, and then we don't have any expense for the store supplies, just other selling expense. So therefore, we will presume that the initial entry for the store supplies is asset. So debited to an asset, which is the store supplies. So in preparing our adjusting entry, we have to recognize the expense. Since the store supplies inventory is valued at 1,012 pesos. So therefore, the store supplies here that is written is not the correct amount at year end. So to adjust, we have to recognize the expense. So we will get the difference between the store supplies inventory ending, which is 1,012, and 5,733. So the difference is 4,721, and that is our expense. So we have store supplies expense. So you will recognize the expense 4,721, and then we credit the store supplies. By the way, we already have a store supplies account above, so we will just simply extend that to the credit side of the store supplies. So just adjust the font size here so everything will fit into the worksheet. Okay. So if there is already an existing account above, so you're no longer going to add another account here in our adjustment. So just simply put it in the debit or credit side where appropriate. Next we have unexpired prepaid insurance. It's still unexpired. So let's check what was the initial entry. So we have here prepaid insurance, and there's no insurance expense. So therefore, what the company used is asset method. So initially, they recorded debit to prepaid insurance and credit cash. So since the unexpired insurance is 700 pesos, so therefore, there's a portion of the 4,800 that has already expired within the year. So since 700 is left unexpired, so how much was the expired portion? So the difference is 4,100. And what do you call the expired portion? That is our insurance expense. Since there's no insurance expense here, we will add the account title. So insurance expense. So again, the amount is 4,100, and we will simply copy this and place it in the credit side of the prepaid insurance. Okay, so every time you prepare adjustments, the debit and credit side should be balanced under the column of adjustments. Next, letter D, estimated depreciation on store equipment is 12,500. So the debit is depreciation expense. Okay, depreciation expense. Then you have store equipment. Okay, so we will shorten some of the accounts. The amount is already given, so no need to compute. So 12,500. And the credit, if we debit a depreciation expense, so the credit would be accumulated depreciation. Since we already have accumulated depreciation here, so just extend that to the credit side. Next, you have sales salaries payable. So let's check if there are already accounts here for the sales salaries payable. So there's no sales salaries payable, only accounts payable. And you have here sales salaries expense. So sales salaries payable is 2,410. So this is the accrued portion, meaning it's already incurred but not yet paid. So we will be debiting sales salaries expense 2,410. But since we already have the account here, so just extend it on the or write it on the debit side, and then we will place this um, the credit account would be sales salaries payable. Again, since there's no sales salaries payable above, so we are going to add sales salaries payable. Then just copy. And then we have letter F, accrued utilities expense. So that's it, basically utilities payable. So let's check if there are accrued utilities here. So none. And then we already have the utilities expense. So therefore, we will just debit it to this account. The amount is 2,450. Okay, so we will just italicize. And then we credit accrued utilities expense, or you can also write accrued utilities payable or simply utilities payable. Anyway, they are the same. Accrued utilities expense, and the amount is 2,450. And then we have the last one, allowance for bad debts is 2,700. So let's check if we already have allowance for bad debts here. None. And if there's bad debts here, none. Okay, so we will debit bad debts expense, or you can just write bad debts, and credit allowance for bad debts. The amount is 2,700. Just copy. Okay. So we're now done with our adjustments column. So this should be balance, debit, and credit. Then we have here, let's extend now the amounts. So since there are no adjustments for your cash, so we'll just copy. There are no adjustments in your accounts receivable, also in your inventory, so we'll just copy them. And of course, you place it on the debit side because um, they have the debit balance in the trial balance. So this trial balance here is the unadjusted portion. Next, you have the store supplies. So since we have here the debit and then here's the credit, so obviously they have this different balance. So what happens is that we will get the difference. If this adjustment was placed on the debit side, then that's add, but since that would be added, but since it's on the credit side, so that's a deduction. So just apply the functions here in Excel. Okay, so that's a deduction. And then the same applies here. So we just drag down. And then you have store equipment. We'll just copy. And then they're the same credit and credit. So this will be added. So just apply the function here in Excel. Let's just add. And then nothing else are being adjusted. So we can just simply copy this one. Okay, to this side. And then here, this is debit and debit, so therefore this would be added. And then no adjustments here, so we will just add, copy, then paste. And then for this one, this is debit and debit, so we will add. Okay. And then for this one, since these items, there are no other amounts under the trial balance column, so this will be just copied and then paste. Okay, so just format this properly. Okay, so now what we will be doing next is to extend this amounts here in our trial balance. So our focus here would be on the amounts found here in the trial balance. We will highlight this one because this will now be your starting point where you will extend the amounts here to the income statement and the balance sheet. So at this point in time, you're only going to focus your eyes here in the adjusted trial balance column and disregard these items here because whatever amounts you have placed here in this column, that will be the amounts that you're going to extend in either income statement and the balance sheet. And of course, we already know what are the account titles that should belong to the income statement and what are the account titles that should belong to the balance sheet. So we are going to transfer, of course, more obviously, the items here from cash until the drawings primarily belong to the balance sheet. So we will going to transfer those items there, going to the balance sheet column. So to speed up the process, we will just copy and then paste it here. Okay, so we'll just change the font. Okay, there you go. So that's until the drawings part. Okay, but of course, so we have to remember that um, for the inventory, this is considered as the beginning inventory. And this one, if you can recall, is our ending inventory. So what we will do is that we have to transfer this amount, this 83,350, to the income statement column. Okay, so this will be blank here. This will be left blank. And then we will now proceed to the, by the way, why we transfer that? Because our inventory should be, our inventory under the balance sheet or in the balance sheet should be the ending inventory. So we will no longer find the inventory beginning in the balance sheet. This is transferred in the income statement because the inventory beginning is part of the cost of goods sold, which is part of the income statement. Okay. Next is we're going to transfer the amounts in under the income statement. So basically these items here that I highlighted are part of the income statement. That's from sales to the utilities expense. So I'm going to transfer these amounts. Just copy and then paste it and then change the font. So we have here the items. Next is we're going to transfer these items here. So which amount should be transferred under income statement and which item should be transferred under the balance sheet. Okay, of course, the inventory end will be transferred under the balance sheet because again this now belongs to the balance sheet items that's part of the current assets. So the ending inventory will now appear in our balance sheet. Okay, and then income summary is part of the income statement. So remember that if it is debited in the adjusted trial balance, it should also be debited in the corresponding columns where it should be placed. If it's credited there in the adjusted trial balance, it should also be credited, for example, in the income statement. Store supplies expense and insurance expense, of course, are all expenses, so they will be placed here in the income statement column. And then you have, of course, depreciation is part of the income statement. Sales, salaries, payable, and accrued utilities expense is part of the balance sheet. And you have the bad debts expense is part of the income statement. And the allowance for bad debts is part of the balance sheet. Okay. So the next portion here would be to get the corresponding balances. So let us check if the items are being transposed properly. If there's nothing left that was not transferred, to check that one, we can add this debit here, debit items here, and then this should be equal to the amount here. So for example, you add 409,158 plus 294,908. So it's 704.66. So there's an excess amount. How about this one? So 469,464 and 229,742. So that's 699,206. So as a result of that computation, so you will see that this debit side has an excess amount. So let's recheck 409,158 plus 294,908. So the excess would be that 704.66. So deduct by 699. So there's an excess of 4,860. Okay. So we have to trace up the items here. So here, this is not the correct amount. So let's not copy that one. So we have 7,481 and it should be 66,460. Okay. Since due to the functions that was also applied here, so let's now check. So 104, 298 plus 294, 908, so 699, 206. Okay, so that's one way on how to detect where are the items that um, were incorrectly posted. So the difference of 4,860 was attributed to this one. That's why I checked the expenses and I found that the functions that are applied here were also applied in this column. That's why it was overstated. Okay, so anyway, we got it traced. So um, we will now get the difference between the debit and the credit column. So the total for the debits under income statement is 404, 298, and for the credit column you have 469, 464. For the balance sheet, you have 294, 908, and credit is 229, 742. So don't be surprised that they are not balanced because we're going to get the balancing figure. And the corresponding balancing figure is either the net income or the net loss. So here we have the credit side is greater than the debit side. So the greater amount will be copied here in the totals. And then the amount with the lesser total here, 404, 298, will be added with the needed amount in order to get 469, 464. So basically, this will be the balancing figure. So the difference is 65,166. Under the balance sheet, our credit side is now lesser compared to the debit side. So we will use the amount in the debit side and copy it here and get the balancing figure. So you will get 65,166. So you will know that you're somehow correct in your process, in the process that you have applied, if the amount here under the income statement is the same under the balance sheet. And you have to be careful. Remember that if it is on the debit side here in the income statement, it should be on the credit side under the balance sheet. If it's on the credit side under the income statement, it should be on the debit side of the balance sheet. And to know if it is net income or net loss, so you can just simply look at the income statement. If the credit side is greater than the debit side, meaning your revenues are greater than your expenses, then of course there's a net income. But if the credit side, which comprises of the revenues, is lesser than your debit side, which is composed of the expenses, therefore that there is a net loss. Okay, so that's all for today. I will be showing you in my next clip how to prepare the worksheet using the closing entry method. We're back to our part 2 of the preparation of worksheet for merchandising concerns. So for today, we will be preparing the worksheet using the closing entry method. As I have discussed in my previous video, if we use the closing entry method, we're going to adjust the ending inventory as part of the closing entries and not as an adjusting entry, unlike the adjusting entry method. So the only difference between the adjusting entry method and the closing entry method in terms of the presentation here is that you will no longer find the ending inventory and the income summary under the adjustments. So I just copied the same information with our previous illustration in our previous video. So we use the same information, the same account titles, same adjustments, except that we will now be applying closing entry method. So I will be converting this worksheet here to the closing entry method. So what we will be going to do is that we will remove the inventory end because that's the difference between the two methods. So in effect, your totals for the adjustments would be much lesser than the one in the adjusting entry method. So let's check under the adjusting entry method. That's 128,562. And then now we only have 28,881 basically because we removed the ending inventory. Now let's transfer the amounts to their correct columns. So to avoid the same error last time, so we will copy the amounts and then we will use paste link. And then the same, we will be removing the inventory under the balance sheet. And since we're using the closing entry method, this is how we're going to prepare the worksheet. And this is where we will be going to post the inventory end or the ending inventory. So the ending inventory again is 99,681. So the first thing we will be doing is we will transfer this inventory beginning to the beginning or the debit portion of the income statement. And then we're going to place the ending inventory on the credit side of the income statement. So that's 99,681. And this amount will be copied in the balance sheet. So that would be the debit in our balance sheet. That's our inventory end. Then the same process, we will be copying from sales. And then again, to avoid copying the functions, we will be using paste link. Okay. Then copy. And then this one belongs to the balance sheet. Copy. And then copy. Now we have the amounts. Okay. So you will know that we follow the process properly if we will arrive with the same balance under the income statement column and the balance sheet column. So both of them have 65,166. So we can presume that the process applied are correct if we will be adding both of these amounts, 404, 298. So that would be 699, 206. It should be equal also here. We have 469, 464, and 229,742. So that should also arrive to 699,206. If you have noticed, it does not have the same totals here. Obviously, due to the added amounts here, that's why it will arrive to 699,206. The same with the total here, 699,206. Again, since our credit side here under the income statement is greater than our debit side, so there's a net income. Otherwise, it will be a net loss. Okay? So this is the continuation of our video demonstration on how to prepare a worksheet under merchandising concern. This time, we will assume that David Music Store applies or uses the perpetual inventory system in recording its inventory. So in the perpetual inventory system, it uses the account cost of goods sold every time a merchandise is being sold. And every time we purchase inventory and we sell inventory, the inventory account is automatically updated. So most likely the inventory balance at year end is already the inventory end. That's why if you can see here, we are using now the 99,681 inventory ending balance and not the beginning balance, because once we bought a merchandise within the year, automatically the beginning balance will be changed. It will be increased by the amount of the purchases. Okay, so the rest of the amounts in exercise 4.1, David's Music Store Incorporated, are the same, except that I changed the purchases, purchase returns, purchase discounts, and the freight into cost of goods sold. Now let us prepare the worksheet if it is a perpetual inventory system. So I have already plotted here the adjustments on the same problem that we discussed in the previous video. And so what we will be doing now is we are going to extend the amount. So before that, I'm going to freeze first our panes, okay? And then we will extend the amounts to their proper columns. So I will copy this one. And then here again, this will be deducted. And then the same. Then copy. And then this one deducted. Same balance. So this is added, sorry. And then copy, because there are no adjustments. This one, since debit and debit, we will going to add. And then copy, and then add. And then for this one, we will just add them. And then let us check if there are any errors in our computation. Okay, so this is amount. Okay, there's a difference. So let us trace them. Okay. Oh, sorry. So this one is on the credit side. Okay. Now they are the same. And then we will be extending the amounts to the income statement and the balance sheet. So for this one, we will be copying. Okay, so we'll highlight this first because this will be our starting point in our transfer. So the same with the process I did last time. So we'll just copy and then transfer this. So from cash until drawings, we will going to paste link here. So paste link will be used to avoid any functions being copied. This one, this goes here in our income statement. And then our store supplies expense goes here. And these items here goes to the balance sheet. And then copy. And then this one goes here. Okay. So we will have here, you have total of 65,166, which is basically the same with the net income here, because I computed the cost of goods sold so that they will be exactly the same with the previous problem. Since we have same balance here under the income statement column and the balance sheet, so it is presumed that we have transposed and transferred the amounts properly. But again, it's not a guarantee that if you have the same amounts in the income statement and balance sheet as correct, your answer is also correct, because there are chances that you made the correct process, but the amounts in itself, when you analyze the problem and you apply your calculations, your amounts was not correct in the first place. But even if it was not correct, but the process in the worksheet was right, you will still arrive with a balanced amount or the same amounts here. So the very important thing you have to remember is that you have to analyze a problem properly, because having correct, having balanced amounts in this stage does not guarantee that the entire work is correct. Okay, so it's important that you analyze the problem properly. But one important indicator that you applied the process correctly is that you are able to get a balanced amount here. What I mean about you apply the process properly, it means that you have extended the amounts correctly. You were not you did not miss any amounts. You did not transfer amounts in the incorrect columns. So that's the applying the process properly. But again, it does not guarantee that if you apply the process properly, you arrive at the correct net income or you arrive at the correct net loss. So the very important technique here is that you start right. So you analyzed it properly and apply the procedures thereafter. Okay, so we're done with our preparation of the worksheets. Okay, so that's all for today's lesson. See you in our next video.